Thanks for this. Thank you very much for being with us. We have about 45 minutes, and during that 45-minute period, we're essentially going to be looking at two things. And if you can get away with it, it will be great. The first one will be, what value does the people here sitting next to me actually deliver to you in this room? And that's really going to be the first part of the panel. The second one will be, but why is still fintech in a constrained environment? Why is fintech still in that teacup, and what can actually unleash it? Is he unleashing a question of client? Is he unleashing a question of regulation? Or is it something else? And that's what we're going to try to unbundle. So maybe what we're going to be starting with you, Luc, and then we're going to go to everyone. Tell me in one sentence, what value do you provide to the people in this room, and why they should be using you?
I think one sentence, okay?
Mm-hmm.
So a transition from today to tomorrow, from the old to the new.
Okay. Philippe?
We have to do it in one sentence?
Yeah.
Okay. Read less, know more.
Raj?
We just save everyone money.
Okay. Jehan?
Well, I'm a VC, so that means by definition I don't provide any value. But in terms of representing blockchain, I would say that the value blockchain provides is breaking down barriers and increasing interoperability of data and value.
Martin?
Insightful analytics, reduction in cost of ownership, and to allow you to drive your business decisions correctly.
So all of you have that one thing in common, right? Which is you can't start talking about data, which is either reading less, either knowing more. Now, tell me on the data side, why is data so valuable? The Economist recently did a special issue about saying that data is the new oil. And how does this actually reflect in you guys' business? So who wants to take that one?
Happy to, since we're in the big data analytics space. I think there's been a trend by which the avenue of social media, and in particular the internet, makes a dissemination of information so much wider broadly. I had a slide downside in the presentation which showed that in 60 seconds there's about 200 million emails being sent worldwide, and 100,000 tweets, and the same in maybe WhatsApp and WeChat here in the region. So I think big data is big and it's getting bigger. But the reason why big data is becoming such an important topic is because the CTO, or the Chief Technology Officer, or the Chief Data Officer is becoming the new CFOs for many companies. It's a gold mine that is completely useless in its raw format, and you need to have the ability to, amongst other things, use computers, natural language processing to extract from this unstructured data, structured data, and then to be able to act on it. If you can extract that structured data, it can allow you to know what your customers are thinking, predict their behavior, predict financial market movement. So this is why it's becoming such a big topic. And we used to hear in every one of these panels or events the topic big data. Now we hear artificial intelligence, but this buzzword is actually hiding a trend by which every large financial institution and every small company is investing time to analyze its own big data and to analyze the big data available out there in social media and news.
So if we talk on data, right? So one part is going to be the analytics. I'm going to go into you, Luc, on that. The other one is actually the data creation, actually where it's hosted, and this is more towards that platform model. So maybe, Luc, if you go on the data analytics side, give us an example on how you start analyzing a document to bring value to one of your clients, for example. Then maybe Raj on your side, which is how do you see the future of data management being, and where do you actually source the data from as opposed to the current model today?
So I think, just pick up on your point, I think, to be honest, there's a lot of buzzwords around, and big data and AI and machine learning and all these sort of things, and we get lost in a hype. I think there's nothing really new. At the end of the day, let's replace the word data with information. Let's replace the word information with knowledge. And the whole financial industry has all been built around either the discovery of information, the packaging of information, the selling of information, and the use of information. So there's nothing new in that, except for what's happened is there's been an explosion in the amount of data, in the amount of in the technology and the ways that you can access new data. And before that was very much intermediated. It was intermediated by the sell side in terms of it was intermediated by dealer to client markets, dealer to dealer markets, and therefore there was a transmission mechanism that was required in the market. So fundamentally there's a market structure change that's happened. And a market structure change that suddenly all data is now available, and it's available in a lot of size. And so there's a real problem with distilling and curating that down to actual really valuable information and knowledge which can then be actioned to make money. And I think so, there's nothing new, it's just size and speed and scale are the three things now that are changed, and the new technologies allow us to address that. So to go to a specific example which you ask, which is, so take research and take written word, is the ability then to access more of it, access it quicker, process it quicker, distill it down, and then use it as information to generate better investment thesis or to enhance investment thesis and to make more money and better bets in the market. So what we can do is, and again, there's a shared commonality on the panel here, is we can use techniques now like language processing to start to look at sentiment and emotion and opinion within documents, within research, and start to distill that for a portfolio manager in the way that he would do it as he reads it. This is not trivial, but it's something that's available now. And so what you can do is you can basically replicate the way and the value that you would get from reading, and you can do that now at scale. And I think the first thing that's going to be delivered is the ability to operate at scale before we even get even more sophisticated than that.
So on the data side, right? So analyzing it at scale and quickly now, obviously data sources have changed, and the way you produce data, this is different now. Part of it is regulatory driven, part of it is cost driven. So maybe Raj, tell me on what's the vision of you guys' platform? There was sort of a pre-Smartkarma, there's a post-Smartkarma. What are you trying to build towards, like in the next 3 years? How are you trying to change research?
Okay. You know, for me, as somebody who's always looked at technology as a means of driving more efficiency, capital markets is the place where you get the maximum multiplier effect through the right use of technology. And I think the lens that I've always put on to examine the market is, where do you see a lot of inefficiency and how can you make it better? And if you look at the world of investment research, and if you look at how it's produced, how people are paid, how it gets distributed, who reads it or doesn't read it, and how then decision making happens, I think you will realize that the efficiency of that funnel or that supply chain is among the worst within capital markets. I'm often quoted, and I do believe that the last big invention for research happened in 1993 when the PDF format took off. And that's really disappointing. The world should have moved on since then, but that it hasn't. So we started Smartkarma with a very simple belief. We felt that the investment research industry could be rebuilt. And we were seeing lots of evidence of that. You know, whether it's Luke's business here or Amareos or the other businesses, we saw there were a lot of new types of insight providers, as we call it. These could be data scientists, these could be analysts, these could be data set providers. There was just this whole new economy that was growing and being developed, which was not part of the traditional financial services sector. And what this economy lacked was efficient distribution and efficient pricing and efficient consumption models. So with Smartkarma, what we're doing is we're rebuilding what we feel is the new distribution and the new market for investment research.
So before I go to you on Jehan on saying, okay, but how can we actually scale these companies, right? From an investor perspective, why can't these companies have the capacity of scaling from financial resource? Martin, on the data part, right? KX System has been around for a while and you have those data sets. Can you tell me about the history of that company and how you've been using data to essentially power businesses?
I'd like to pick up just on one point. I mean, we've got, we're seeing today, an explosion in data. And you can categorize that data across a variety. Luke's mentioned it: volume, veracity, the trustworthiness of it, the velocity of it, and the variety of that data, okay? The key point is, and whilst we're in a digitization age, and we talk about the digital footprint, I think there's also a fundamental concept that we need to go back to, which is garbage in, garbage out. And a large challenge that I see with clients in the industry today is a spaghetti of architecture, different data formats, and if you can't make sense of that data, and that data is not in a format that you can ingest and normalize, easily clean and maintain, your cost of ownership is huge before you've even started to make sense of the information. So a large part of what KX Systems have concentrated on over the last 25 years is delivering a data capability that allows you to clean, validate, and then provide insights of that information, whether it's in real time, whether it's historical, and then when that real-time event happens, put it into the historical context, and then to take an action on it. So I think the challenge is still on normalizing that information, making sense of that information, whether you're an asset manager, whether you're looking at research, and then whether you wish to combine those different data types together. And I think that, I'm not saying it's been underestimated, but we were talking about data normalization, consistency, accuracy of information 15, 20 years ago. And those dynamics have not changed. And so the data modeling that you see from whether you call it big data, fast data, is fundamental to everything that you do. And I think the other fundamental aspect in terms of what's driving those business decisions quite clearly is the regulatory framework, which is now forcing institutions to go down a path whether they wish to or not. Certainly we see it in the States and in Europe, and best practice maybe in this region. That is what is going to force that data transition and that continued digitization going forward. Because even with those institutions who have a well-renowned digital platform, they're still struggling at the back end with the data lakes, with an open source architecture, with a license architecture, and how do I integrate those offerings so my client experience is as smooth, seamless, and transition as we want.
So Jehan, to what extent do you agree on that? And is regulatory a barrier, an enabler, or a mix of both? And
well, actually, if you don't mind, I just want to address the one point about data integrity, because I think we were talking about the impact of data, and really I think that the consequences of data are much larger than they were before. With digitization of kind of infrastructure and mechanics, a lot more of our lives are actually determined by actions taken by infrastructure, which is contextualized by the data that we have. So the data flow, the integrity, where the data comes from, how true it is, and how it's used along the way, who has access to it, is much more important, because it's one thing if the data around news is incorrect and perhaps it throws an election. That's not great. But on the other hand, if you have bad data which then shuts down an electric grid at a critical time, that's a whole other thing.
Yep.
Now, thinking about it, from my lens, which is, as a blockchain venture capitalist, we look at blockchain as a way to secure the data stream from source all the way to consumer. And I think that the ability of blockchain going forward to integrate into data sources, into data feeds, into hardware, and have the ability to kind of show that data is true at source, and whether you believe the source or not is another question, but at least it has integrity when it's taken in, it's not been manipulated, and it's mathematically uncorrupted all the way down to when you get it, is actually a really important benefit to how we think about data going forward. It's the truth of the data, regardless of what the data is.
But if you talk about this, right, so you're talking about blockchain, say how the data is totally secure from input all the way down to actually its usage, right? How do you go by preventing incorrect entry of data? We talk a lot about data lakes, they have wrong data in, and then it becomes sort of a nightmare of actually solving it and getting value out of it.
Yeah.
So now you go in the blockchain world where things are immutable, you can't change it.
Fair enough. So blockchain is just a tool, all right? It's not a truth mechanism. It's a truth kind of tool in a sense. As you said, garbage in, garbage out. If someone puts in bad data and locks into the blockchain, then that garbage is locked in the blockchain. Fair enough. But what I think is interesting about the blockchain is that it changes the paradigm of single source truth to multiple source truth. So for example, a person's identity no longer relies on one single authority, say a government. You can actually have identity scoring, where you have multiple points of validation and identity all the way from social validation, the people around you, people who are meeting you physically, to the government, to your credit, whoever's handling your credit, and your quote-unquote true identity is the balance of all of these validators. So that kind of multi-scoring or multi-kind of pronged source of truth, I think, is a really big shift from single source authority of truth to kind of multiple validators of an idea of truth. And then from there, you just take a look and you see, well, which data source has the highest scores. Then that's the one I'm going to believe going forward. Because this idea of single source truth, it's not really scalable.
So if I just bring it back to, you started mentioning a few times identity, humans, impact on peoples, right? Now, we talk about data, and it's a very abstract. So if we bring it back to the impact on people's lives, on jobs, right? Hong Kong as a financial center, it's about 16% of the workforce. Now, tell me how employees can actually leverage the data to be even better than what they used to be, right? Because how do you leverage data? How do you not replace, but you augment a person? Is that anything that one of you guys do in terms of a solution?
So, I mean, I'll take this one. So we used to have a phrase back in a previous life, which we weren't allowed to use, and that was non-human intervention. We used to build trading models, and we used to build price construction and investment models which were non-human intervention. And we sort of got it to a point where there was no human intervention in some of this stuff. But being now closer in the Bluepool context to what this is all about, and we see all these big headlines of rise of the robots, rise of the machines, and all this sort of stuff. What we do, and I don't know if anyone saw Samir's presentation downstairs earlier on, but just to give a little brief insight into that, is what we do is look at the human behaviors, human actions in a firm that drive revenue. Take those human actions, systemize them, and then throw lots of really, really valuable data at it and supercharge it. But what we're doing here is actually supercharging the human being. And what we find is when we do this mapping, we find that people do turn up in the morning and they do quite robotic actions anyway, and they're not actually using a lot of the capacity that's free and available to them to do, and they're restricted by process, culture, different other combinations of events. So I completely dismiss, completely dismiss, and would like to be challenged on the fact that we are not going to go into a decade of rise of the robots. We're actually going to go into a decade of the actual superpowering and supercharging of the human being in his current, and we're going to allow them to operate at a better level and actually start using more capacity and break out of this methodic sort of way of looking at it. So if you take a PM looking at his investment portfolio, there'll be certain things that he does, and it's very methodic, which can be taken away and systemized, but it frees him up to say, look at more creative alpha generating activities. And so we're going to get a redefinition, and a redefinition of quite a lot of roles. That doesn't mean it's a replacement of quite a lot of roles. And I think it's going to be quite a long time, unless you're thinking of creating the next Bridgewater, Two Sigma, non-intervention type funds, that the human being will become replaced in this.
So if I just keep you on this thought, by the way, you all have an app and you can ask questions. We have about 25 minutes left. If anyone wants to jump into a question right now, just on that specific topic about human and will human be replaced in the context of data analytics, do it now. Otherwise, start keeping your question in mind, and we're going to jump into this in about 15 minutes from now. So start preparing you guys' questions. Now, we use the word supercharger, which I highly appreciate. Obviously, being the founder of SuperCharger, it's always good. And Philippe, yourself have been supercharged with us last year. Now, tell us on Luke's point. So do you agree that you guys are an enhancer as opposed to a transition technology for human intervention? And if so, how?
I think that there is a demonization of technology in the general fashion. Some of it is due to some very nice science fiction movies that were dated, like Terminator a few years ago, and the rise of the machines and robotics and Skynet trying to take over the world. I 100% agree with Luke that we are decades away from having machines actually take over from human beings. However, I think that machines are here to help us the same way as during the Industrial Revolution. The technological revolution is allowing us to the extent that the tasks that we're accomplishing are repetitive and things that can be automated, they can actually do a very good job of being our assistant and making our lives better by allowing us to do these automations. The first thing that comes to mind, for example, generating a legal document or a prospectus or a term sheet, you actually don't need a PhD in mathematics or in finance to be able to do that. And a lot of the law firms are actually starting to use machines to be able to generate those legal documents. And in the US, with the SEC creating these free writing prospectuses, it is much easier to generate these legal documents relying on technology. So my view is that to the extent that technology allows us to do a repetitive task, it is better than humans because it doesn't do any mistakes, and it can actually help us automate it. Another area where we talk about is robo-advisory, and whether a lot of people in this room being in asset management, this is going to take over your jobs. Far from it. I think robo-advisory is very far from being the in-all and end-all solution. It's just another customer experience. It doesn't even outperform the good job that you do understanding your clients and servicing them, but it is a tool that maybe you want to have to be able to allow you to automate some of the process that you go through whenever you're speaking to your client and allow you to understand them better. I don't think that robo-advisory will take over from asset management either.
Just Martin, can you also touch on the same point, right, which is enhancer of people and essentially their work or replacement? So where do you guys go, and essentially if you enhance, how do you enhance someone's job or firm's business?
So basic example, if you look at some of the SFC guidelines on manager responsibility. So in today's market, individuals are personally responsible effectively for the operations of their business. I think what technology is doing is helping move the lens across that value chain so that the effort and the time and the cost is not around preparing the data, actually it's around actioning the data. And so a simple example is, if I'm personally liable, what technology is now giving me in a timely, efficient manner is an alert that says there's been a wash trade. And rather than look at it at the end of the day, you look at it now. You've got that alert, whether you're in the front office, the back office, or compliance, from a best execution perspective. So what it's doing is, certainly in relation to that regulatory framework, it's protecting people's roles. Mm-hmm. It's also preventing systemic risk and volatile and adverse markets. So that's a clear example of where technology is adding value and changing that lens, which then allows people to look at, well, you know, the whole ecosystem of the financial markets is moving, right? The models are changing because of the financial crisis, which is well publicized, and how you use balance sheets, how I provide services at the end of the day, on what is my business model that I want to achieve. And technology is an enabler.
Right.
And what it's doing is moving from one model to another model through an evolution. Okay,
so you have that evolution, and I think we all agree here that the rise of data availability, whether created from scratch or their sources, is increasing, right? Now, you did touch on the regulatory side, which is trying to protect either from a policy perspective, from a consumer perspective. Now, what is breaking that link between data availability, data access, right? We live in a world where there's even more data than there has ever been. A Tesla generates 100 gig of data per mile driven. I mean, even hard drives today can't handle a long ride. So data is more and more than available. You guys are doing data analytics. So how can we actually unleash you guys to actually tap into that huge asset potential which is all around us? What are the barriers in that? So maybe Raj and Jehan.
So Smartkarma does not do data analytics.
Okay.
But it allows you to get any kind of analysis from other people who do data analysis. You know, I think it's very important that we distinguish business models here. I feel data is a commodity. You compared it to oil, or The Economist did, and it is exploding. We all know that. And when any commodity explodes at the rate at which data is exploding, and actually no commodity has ever exploded at that rate, you see a whole new ecosystem around it. You know, there are manipulators of that commodity. There are deliverers, the guys who sell shovels, the guys who sell hard disks, right? The problem is, when you have a new ecosystem that is so fragmented and growing so fast, I think the single biggest pain point becomes, how do you bring it together? How do you create value? How do you connect the buyers and sellers of each of these different data products in a single, merged, unified, frictionless ecosystem? That's what Smartkarma is trying to do. So we are not in the business of doing data analytics. We are in the business of connecting people who are in this space with each other and allowing them to exchange services and distribute or transmit unit values that are created. I think, and I think one other point previously about sort of jobs. Yeah. I actually think that we would be kidding ourselves if we feel that there will not be a job vacuum for a period of time. But I think the best thing to do is to look at how similar case studies have evolved in other sectors. In many cases, the right application of technology has led to job losses for a period of time, but has then led to a much more efficient and larger market, which has led to an explosion in the number of participants who can then be on that market.
So look, the creation of the market is actually an important one, right? And I'll go on you, Jehan, on that. Just thinking, when you look about fintech in Asia in general, huge opportunity. I think there's no doubt in the amount of investment, the amount of people that we could serve, the amount of financial institution, the fact that there's an infrastructure back, et cetera, et cetera, et cetera. Now, as a market, I think the industry is professionalizing itself more and more. Take the US, for example. You do a hackathon, the winner gets 50K to 100K. The startups that actually do something valuable gets paid as a valuable startup. You draw an accelerator, you get 200K in, right? Now, to create that market, to make it a professional market that is actually valuable and evaluated by the participant, what's the role, for example, from an investment perspective of this? And then I think for you, on the startup side, what's the value of a Thomson Reuters or any essentially financial market participant to enhance you guys, to start distributing you, right? So first on Jehan, how do you make a professional market in fintech? How can you guys, from an investment standpoint, professionalize that industry, but also start connecting the dots between the players?
Sure. I think blockchain is a bit special because there's somewhat of a mental moat around it. I know many smart people. I'm not one of them, but many smart people still don't get exactly what blockchain is and how it can be applied, and that makes a lot of sense because it's a slightly different animal than we've seen before. The best way that I like to describe it is the next chapter of the internet. Now, when you think about what the internet is, it's hard to say, well, it's this product or that product, the way you can say that AI is this or machine learning is this or IoT is this. It's just another layer of the internet. It moves information around, arguably better, faster, cheaper. Now, when we think about kind of professionalizing the startups in this space, and even more importantly, the institutions and how they use blockchain, how they understand blockchain, it takes a lot of time, and it takes getting your hands dirty. And the biggest problem I think that we've had as investors in this space is twofold. One is that institutions are, like financial institutions and even governments, you know, the Hong Kong government, bless them, they're doing as much as they can to try and push along engagement in blockchain and other technologies, but it just takes time, and they have a responsibility to the constituency to take things slow and in a measured pace and in a safe way. Fair enough. But it does need to happen a little bit faster. On the institutional side, there's a lot of POCs. Everybody complains, yeah, blockchain, I heard about it. I've seen these POCs, but where are the real use cases? Well, it takes a little bit of time, and so one of the barriers is just patience. It will take a little bit of time. The second barrier, especially in Hong Kong, is development talent and the ability to have actual developers and coders who are proficient in coding blockchain applications. If you want to develop in this space, if you want to support startups and also the institutions in using the technology, there has to be people who can actually code it. And Hong Kong historically has been slightly more challenged in terms of providing developers, which is, you know, one of our investments actually is blockchain training. It's not really in our theme of infrastructure and middleware that we look at, but we think of it as a critical layer for the development of the space, and so we invest in actual training as well.
So I think this is actually a very good point. I'll just give you a fact about Hong Kong, right? So let's say the financial services industry, 160,000 people in Hong Kong. They hire 5,000 new people a year in finance, right? Hong Kong currently has only one university with a fintech course, and the capacity of actually training people, fresh graduate at that level in Hong Kong is about 200 people a year. It will take Hong Kong 25 years to train 5,000 people. And that's a yearly intake. So the education piece, which is needed on the talent side, that's right, but where I would challenge and I would like you guys to go is patience, right? I think one of the things that startups have because they have to, but from a cash flow, is not patience. Patience is something that kills you, right? So,
I mean, yes and no. I mean, I think if I just walk you through a storyline, I was on your side of the fence, I'm now on this side of the fence. So if we take what the theme of this panel was storm in a teacup, well, you guys are the cup, we're the storm, okay? So the thing for me, which I see in this, running through this, and when I was on your side of the fence, was very simply a cultural point within the organization. Do I want to change or do I have to change? And this is a very, very fundamental point. And it's like the exhaust on your car. If you are basically, you have to, then you will wait till the last minute, you will do it at the cheapest price, and you'll probably do it when there's an event or a crisis. If you want to do it, you will buy the best exhaust out there, you will change your car very quickly, and you'll have the best car out there, and you could potentially create a competitive advantage for yourself. That's me talking about it positive, and people could argue against me on that point. However, there's a big difference between want to and have to. Want to and have to then defines for me the size of the cup. Therefore, that's the cup in Hong Kong at the moment is pretty small compared to other markets at the moment. And therefore, the storm inside there's a lot of power, there's a lot of fintech, good fintech people out, there's a lot of really great technology, and the storm is brewing. And then this gets to another point. We hear a lot of the words disruption, and maybe a little bit of fear out there. So if the teacup is not big enough, if you guys do not want to, and you just have to, and you wait till the last minute, and we do the last things, and we do it at the cheapest price possible, then there will be board meetings happening in fintech companies with investors who will say, let's not even touch the cup. Let's go and do it outside, let's capital raise, let's build it and attack. And therefore, what I will do is I will go in and I will disrupt you. And therefore, we will look at a longer-term game of that. And this isn't trying to create a fear or anything like that. It's a natural commercial discussion and decision which will happen in the fintech communities. And you're seeing that in certain industries. You're seeing it more in the retail space, like transfer wires in FX and places like that, where they've taken a decision not to participate in the cup. They are going to create their own storm, and they're going to go for it. And I think this is now in Asia, across Singapore, across Hong Kong. I take away mainland China. I think it's in its own different storm with a huge bowl, not a teacup, is the fact that there is going to be this dilemma play out. Do you guys want to change? Do you want to do it? If you do want to do it, get involved in the storm. If you don't, the storm will come. And I think that's a debatable point, but it's a point I throw out there.
Is there anything that you guys have seen, like Philippe or Raj, on who will be your client, right? I had the example once, which was one of our companies at SuperCharger was Bamboo, and Bamboo is a B2B robo, but then they decide to actually look at doing a POC with Uber. They go, financial institution gives me that many clients and it's that long to do, whereas the Uber goes, yeah, we'll sign it straight away and then we figure out how we do it, which is another problem altogether because then you need to figure out what you're building. But you start having more and more fintech companies that do go, it takes me a year to sell to one financial institution, it takes me a month or 2 months to sell to another tech provider that has a large customer base, right? So did you guys at any point in time in your company start thinking, which market am I actually approaching? And are you still on that verge of saying, I'm still going to go on the financial institution side, or I'm going to do a end approach where you add new clients which you never thought were possible at the beginning?
Right. I think
You go first.
Sorry. You mentioned, I think, Hong Kong being a financial center. Obviously, a lot of people who are sitting here used to be on the other side of the fence, if that's a way of talking about it. And if you look at the typical profile of the startups in Hong Kong and Singapore and maybe in the rest of Asia, these are all ex-bankers or ex-asset managers that decided to take on a challenge that they saw that their industry was faced with, and they tried to address it. The research is one of them. Systems and technology is another. Big data is another example. I think the reality is, just to give you a sense, in Hong Kong there are maybe 200 startups in the fintech space. That's not a lot. That's less than what in one day might happen in terms of mainland China, the bigger bowl. There might be 200 new startups every day in China in the fintech space. The other reality of Hong Kong is that it's a small market. It's just 7 million people. So most of what the businesses of people who are in fintech in Hong Kong are doing is a B2B business. And by definition, as opposed to a B2C, business to consumer business, it takes much longer time, because before a financial institution decides to actually transact or do business with a small entity, it takes a very long time. And hence, you mentioned the word patience. I think definitely those 200 fintechs that are based out of Hong Kong need to be very patient, because their primary customer base, being those financial institutions, will take a long time, especially in the current environment where they're occupied with regulatory compliance and other areas, before they actually are willing to work with small entities. Earlier you mentioned what an institution like Thomson Reuters can bring, and we talked about integrity of the data. We were privileged because it took us about a year and a half, but we did manage to get an official partnership with Thomson Reuters. And to be honest, in the business of data analytics, if you don't have good data, it's garbage in, garbage out. And we get our data and our sources thanks to Thomson Reuters on that. So being allied with those big financial institutions, whether they're your clients, whether they're your partners, whether they are your distributors, because getting access to TR allows us, for example, via their App Studio, to have access to 400,000 users globally, and we can have our product distributed that way. So I think the way to grow this business and to make it from a cup into a bowl is to actually partner more rather than threaten and say we're going to disrupt you. I don't believe any startup will disrupt the big financial institutions here in Hong Kong. It's different in China. They've already created their own storm, but I think the best way is to try to figure out how to be patient and to have the ability to be patient, because unfortunately, we talked about fundraising. Hong Kong is still a very, very small universe when it comes to investment, whether it's the VCs or even the government fund, which is now up to 5 billion, but last I checked, zero has been deployed. Yeah. Zero out of the 5 billion Hong Kong dollar has been deployed to any fintechs in this region. So
must be good interest rates.
Martin, I have a question on that, right? So from the data you guys hold, have you ever seen a change in your client base more recently, right?
Sure. So back to your previous point, it's for a company of our size, you've got to have a balanced portfolio.
Yeah.
So our heritage is in financial markets. Over the last 5 years, we now have clients in telecommunications, clients in industry utilities, through IoT, through the sensory devices, talking to retail institutions for POS, inventory management, real-time merchandising and stock control. So data is data. We're very fortunate to have a platform that is agnostic to, firstly, the data that we store, and then secondly, how you process and then present those results back. And we can do so very efficiently. So I think from a fintech side, you've got to have, we've seen the financial markets and the turmoil they have. You've got to have other sectors which are performing to allow you to continue to generate positive return, to then continue to invest in the underlying technology itself. So I think when you have a industry agnostic technology capability, I'll go back to the fundamental will be the quality of the data that you have, that it's true, it's authentic, and then what's the velocity of that data, how quickly do you need to process it, and what is it I'm trying to achieve, and that dictates what application you use this thing for.
Okay. We have about 5 minutes left. I am taking the questions that you ask as we go, and I'm including them essentially in my question to the panel, so please do keep on sending me a few questions, and I have, I think, about time to add 2 more questions, unless someone wants to raise their hand and go all public. No? All right, so checking one more time. No? Okay. You guys are adding value, right, in terms of the data analytics, and you use raw material, and then you are extracting it to then fuel a whole industry, whether it's the financial services industry or whether it's any other providers. Isn't along the way of that value creation also destroying value on the capacity of actually analyzing? Analysts used to do a specific job, and this value now is being replaced. So how do you retrain those people, and what's one of those considerations? Hong Kong, I think, consideration, we said, maybe is it keep artificially constrained into this environment? Because if you were to replace 160,000 people in a year, what does it mean for Hong Kong as an economy in general, right? So how do you help on that transition? How do you make someone better, and you make a case to your firm, essentially?
Sure. I mean, one of the most interesting and sort of almost amusing to a certain extent trends we see with investment research is that competitive intensity is rapidly declining. A lot of the large participants, large banks or brokers who used to hire some of the best, most highly educated, talented, qualified analysts are now no longer keen to keep those jobs. They are shedding, shrinking, shutting down those departments. And we see that as a very interesting problem in itself, because in the world of juniorization and outsourcing, it's actually the best minds that are being let go. So one of the problems that we are inadvertently solving through Smartkarma is creating sort of a new economy and new jobs for some of the best analysts who now want to operate in an ex-bank environment. And what becomes quite fascinating is that equipped with a new incentive structure, one that's not based on how much your boss likes you and hence rewards you at the end of the day, but based on a much more objective, transparent, monthly incentive structure, you can actually also unleash collaboration. So, someone who works in a silo might lose their job because that silo or that cup or that bowl, whatever, is cracked. But together with somebody else, they can co-create new value. So something that we see happening on Smartkarma all the time is, like for example, a telco analyst, right? Telcos have been going out of fashion for a few years now, right? So the telco analysts have also lost their preeminence. But a telco analyst coupled with maybe a fintech analyst can come up with some very interesting research conclusions. So unlocking collaborative value is phenomenal. In fact, Amareos, for instance, are one of the insight providers on Smartkarma. So we already see various ways in which many different domains of expertise can come together, collaborate, and create very unique end outcomes and jobs and much better value add. So it's sort of winning by creating win-wins.
So you said win-win, and me, I frame it differently, which is you have fintech, finserv partnership, fintech companies with essentially financial institution, then you have fintech partnership. Now, if you had to pick between one and the other, what is the barrier of actually having companies using data? Is it a regulatory barrier or is it a cultural barrier? And once you make the pick, say why. We have about 2.5 minutes left, so it'd be good to say, what's the barrier to actually accessing data and for you guys to go on that side and work essentially with these companies in front of you? Is it a regulatory barrier or is it a cultural barrier that needs to be resolved?
Accessing data?
No, for you to actually work with them and let them have you access their data.
I think it's maybe to just draw an analogy, large asset management groups or large financial institutions are like a big oil super tanker. They cannot maneuver very easily. They need those tugboats to be able to push them or pull them on one side or the other. I think, unfortunately, the reason why it takes so much time is that simply it is a process, and that's where you have to be patient, where it requires approval from, in some cases, New York or London or other many different people, layers of management to be able to, even if the people on the ground here like the idea, before they can actually implement it, there's a long time. So I think it's less regulatory. I don't foresee this in our case, for example, if an asset manager wants to be able to use new insights, to be able to look at financial markets differently, the regulators are not going to tell them don't do that. It's just simply their internal approval processes that might take a long time before they can actually implement it. So it's not, in my opinion, a regulatory barrier. It's more a bureaucratic process of large financial institutions that cannot maneuver like a supertanker.
You guys will agree in about 20 seconds each?
Well, I think it's also jobs. Sometimes embracing a new technology or a new solution or a new business model is inadvertently sort of cannibalizing internal jobs. And that always becomes an impediment. Like Smartkarma is a new way of doing research, consuming, producing, monetizing, and it replaces the old world. Some people do not want to be replaced. So that's a barrier. But is there a cultural barrier? Hell no. I mean, we have global clients. Is it an economic barrier? Absolutely the opposite. There is a big economic incentive. Is it a regulatory barrier? Absolutely not. We're fulfilling the needs of new regulatory requirements. So I think it's just a juxtaposition of personal interest versus good for the greater good.
We did a legal review of every single country in Asia around data, and it's quite a deep thing. There's a lot of difference and variance, but there's one common denominator that runs through nearly every country, and that is disclosure is king. If you tell people what you're doing and what you're doing with the data, and people agree to that, then pretty much every jurisdiction is reasonably okay with that. So I think a legal framework at the moment in that sense is okay, but again, we have certain regulators where the legal framework hasn't caught up as much as the technology and the data usage as yet. So there's a grey area and a sort of a murky area which needs exploring in terms of the regulatory legal framework to catch up. But to solve that, disclosure is absolutely key. Martin
and Jehan, as a close?
My view is I think transparency is driving that behavior. The regulation might be the framework in which it happens, but to Luke's point, it's transparency, and there's a demand for more of it.
Mm-hmm.
I think data ultimately wants to be free. It's like a bag of cats, just wants to kind of go everywhere. And I think right now, data is kind of siloed, either in institutions or in technical infrastructure or in jurisdictions. And the biggest barrier to people using the data is that either you don't know it's out there or you don't know how to get it, or it's too hard or too expensive.
Yeah.
And so, from a blockchain perspective, I mean, having data which is kind of on this more permeable and more kind of overarching layer, I think will just increase the ability to have real-time visibility of what's out there when you need it, and where to find it. So,
Okay. Well, look, thank you very much for this. We run out of time. There's quite a few questions also. Some of the panelists will actually stay behind, so please do ask them the question. I would like everyone to applaud for the great panel. Thank you very much.